Good evening, all the joinees. Thank you so much for joining for this webinar. So, hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. Meanwhile, others join, I'll just introduce our topic for today. Predominantly, our discussion today in this webinar will revolve around reviewing of client portfolios and generating actionable proposals or AUM-based proposals. So for that, firstly, we will understand how can we really benchmark or understand the portfolio performance against a benchmark. We will see how we can really customize our benchmark to one specific criteria. So let's say it's a 65-35 equity debt portfolio. We will see how we can actually customize such benchmarks and actually mark the portfolio performance against such benchmarks. Moving ahead, we'll also see the up capture ratio and the down capture ratio of your portfolio, which typically tells you how much does your portfolio perform in a bull run versus what is its performance in a bear run. We'll have a look at that. Once we move ahead from that, we'll have a look as to understanding how much of the components in the portfolio contribute to the overall portfolio return. This becomes very, very crucial because ultimately when the decision needs to be done, okay, these are the schemes that needs to be exited, and okay, these are the schemes that need to be added. So that will really, this decision is typically depends upon the contribution analysis, and we will have a look at the contribution analysis as well. Next, moving ahead, we'll have a look at the rolling returns analysis and the scenario analysis, wherein we will see how our portfolio performs in various different scenarios. We'll have a look at that. We can create your own custom scenarios and have a look at how your portfolio performs in those particular scenarios. Next, we'll move on to a very crucial part, which is the drawdowns analysis, which will actually tell you as to what is the strength of your fund of your portfolio to recover from a loss. Typically in volatile times, it becomes very, very important to reassure your client, like that even though the markets are volatile, look, don't get jittery and panic sell, right? If you can just hold in for a little long, depending upon the historical recovery of your portfolio, your portfolio returns will be outturned, right? So that becomes a really important parameter. That's the drawdowns analysis as a feature that we have. We'll have a look at that. And next, we'll move ahead to the customizable reports generation. I will show you how you can generate a client-based mobile link, share link, which is a desktop or a laptop-based link that can be generated. Of course, the other reporting options like a PDF, PPT, those are available anytime. And then finally, we'll throw the forum open for a Q&A session, wherein you can ask your questions by either typing in the chat box or unmuting yourself to speak. So let us now begin. So specifically for the platform, walkthrough or the webinar overview today, we will head over to the portfolio section right here. This typically is the landing page of this is the landing page of NGEN Markets, and for our webinar specific discussion, we will head over to the portfolio section. When you go to the portfolio section, you load in a client's portfolio. So for that, just click on this drop down and run the particular client's portfolio. So let's say this is the particular client's portfolio, Raj Malhotra. I want to analyze this. I click on the drop down. I click on run. Okay, a detailed portfolio analytics gets open. So, though it is very, very important to showcase how your prospective client's portfolio looks to acquire new business, reviewing existing client's portfolio is equally important because ultimately those are your assets. That's how the robust analysis you provide of their portfolios, the better it would be for your relationship with the client. Right. So just click on the name of the client and run analytics. The entire detailed portfolio analytics will open up. So you can see, firstly, this particular client's portfolio is 55% into equity and close to 37.88 into debt. Right. There's some amount of cash, foreign equity exposure as well. So how will you check that? So for an example, this portfolio does not have a direct stock holding at all. There is no direct stock holding. This is a purely mutual funds portfolio. You want to have a look at where is this foreign equity exposure coming from. Just click on foreign equity as a bar graph, and you will actually see that this portfolio is exposed to Microsoft, Alphabet, Amazon as a stock. And how is this coming from? Just click on this I button, and you will have a detailed list of that. So Parag Parikh Flexi Cap, which is a component in the portfolio to an extent of 13.19%, holds some amount of percentage into Microsoft as a stock. And therefore, through Parag Parikh FlexiCap, your portfolio is being exposed to this foreign equity exposure. Okay, this becomes a crucial analysis. You can do this for any minuscule component in the portfolio as well. So for an example, you want to have a look at these 0.27. What is this others? So this derivative derivative future position that is held in DLF as a stock, and that is held by what? Axis Focus 25 fund. Okay, so you can check this for even a detailed small portion in the portfolio by just clicking on that particular bar graph, and this will get open here. Click on this I button, you will have the details here. Of course, a detailed analysis for the equity and debt is anyway available. Just click on equity and you will see that this portfolio is exposed to ICICI Bank as a stock to an extent of 2.30%. You want to know where this exposure coming from? Click on this I button. We can see that Bandhan Sterling Value Fund, Motilal Oswal, Axis, Parag Parikh, all of these are holding into ICICI Bank, and therefore the portfolio is exposed to a 2.30% into ICICI Bank as a stock. Right? That's the overview analysis that you can do. Now, let us move on to the concentration analysis. What this concentration analysis tells you is what is the exposure in each of the market cap wise exposures of the portfolio. So for an example, if we do this as a percentage of equity, the equity in the portfolio, as we saw, is a 55 odd percent. Okay, so if we have to have a look at what is the split between large, mid, and small, just use this drop down and choose it as a percentage of equity exposure. And we will see that in this client portfolio, 54% is coming from large cap, 33% is coming from mid cap, and 11% is coming from small cap. That is a detailed analysis, a split analysis that you can do with the concentration analysis. Now you want to check this as a percentage of overall portfolio. That option is definitely there. Just click on this particular drop down and choose it as a percentage of total portfolio. And typically the others that you will see here will be anything and everything that is not equity. So debt, foreign equity, cash, all of this will get sorted or get classified as others. Okay, that's the concentration analysis. Next is the AMC Wise Exposure. In the AMC Wise Exposure, what you can really see is with respect to these AMCs, what are the underlying funds of those AMCs? So in this case, we can see that Bandhan AMC, 23.48% exposure in the portfolio coming from Bandhan AMC, and the underlying funds are Bandhan or IDFC Banking and PSU. Of course, the merger happened, so IDFC became Bandhan. So Banking and PSU debt fund and a Bandhan Sterling Value Fund. So these are the two funds in the particular portfolio. You can just click on any other AMC and you will have the names of the underlying funds. That's the AMC wise exposure. Next, we have equity sector wise exposure. So this helps you in understanding to what extent is your portfolio exposed to one particular sector. So going ahead, if you see that IT as a sector will, if your outlook says, okay, this is not going to be very, very good days for IT as a sector, right? And then you want to see that, okay, to what extent is my portfolio exposed to that sector? Directly head over to equity sectors, and you can see that currently, based upon the current holdings in the portfolio, your exposure into IT is 4.28%. And that is coming from which underlying stocks? Just click on IT software as a bar graph and you will see that these are the underlying stocks from IT as a sector, and that's contributing to the portfolio exposure to IT to an extent of 4%. Okay, this is a equity sector wise analysis that you can do. Now we also have some debt component in the portfolio, and we would like to check what are the credit ratings of the debt part of the portfolio. So for that, head over to the debt tab, and from this drop down, just choose as a percentage of debt exposure. The debt in the portfolio is what? Is a 37 or so 38 odd percent, right? So if we assume 38 odd percent as 100%, what among that 38% is coming from a AAA rated or a sovereign rated? So for that, you can check this like this. So AAA rated securities are 80% in the portfolio's debt component. Sovereign is a 16 odd percent. A rated is very, very meager, 0.32%, and definitely AAA rated is a 3.77%. This becomes very, very crucial to understand typically in the debt component of the portfolio. And this analysis is something that you shouldn't really miss. right? Then with respect to debt, again, average maturity of the portfolio's debt part, that really depends upon the underlying debt that the portfolio has. So we can see that GSEC 2033, NABARD NCD में there's an exposure of this portfolio. REC limited debt component is there in the portfolio. So that how much that does that contribute to the portfolio average maturity and the average duration, right? That really tells you leaps and bounds about the debt part of the portfolio. Next, moving on to the performance analysis of this portfolio against a benchmark. So let's benchmark the portfolio against a reference index. Currently, it's being benchmarked against a reference index 5, which is a combination. This has, of course, been auto-benchmarked against this index with a combination of a 60% Nifty TRI and a 40% CISL bond index. That's the closest that this combination could find to the particular weightages in the portfolio, right? You can, of course, customize this. How can you customize that? So for that, you'll have to head over to direct custom benchmarks. If you click on this, you will actually be able to assign the respective weightages to the benchmarks and build a customized benchmark. Head over to custom benchmarks, manage custom indices, and load in this new particular window. So typically for the equity exposure, we'll have a benchmark of a Nifty 100. When you add that particular benchmark, click on add index, and this will get added. Give it an allocation of 55% because 55% was equity in the portfolio. Once this is done, locate a debt relevant index. So it's a CISL bond index that you would like to consider for benchmarking. So add that index and give it an allocation of another 40%. And the balance 5%, of course, was some cash, some foreign equity, so on and so forth. So what you can typically do is maybe give in an allocation to a NASDAQ or a Dow Jones to an extent of the balance 5%, which is typically exact benchmarking to the foreign exposure in the portfolio, right? So let's consider a Dow Jones and give it an allocation of the balance 5%. Once this is done, just name your portfolio. So, name the benchmark. So let's name this as a custom benchmark 55 and click on save. Once you do that, of course, this will take some time to save. Once this is saved, this custom benchmark can not just be used for this portfolio, but you can actually benchmark any other portfolio's performance to this particular benchmark, if of course that is in the same proportion of it. So this is not specific to a particular portfolio, but this is specific to your login. Okay. Once this is saved, just click on cancel and you will be able to locate this benchmark here. Click on this custom benchmark too, and your portfolio is now being particularly benchmarked against this particular benchmark. Let's run this analysis, let's say for a period of last 3 years, 3.5 years. For that, we have given a custom start date option. Click on this custom start date, and let's take this from January of 2020. When we put in this particular start date, now the portfolio's entire performance is benchmarked against the benchmark that we just created from a start date of 1st of Jan 2020. And we can...
Prajakta, sorry to disturb you, but I just wanted to know that you are rebasing it from January 1st, 2020, but at that time the allocation would have been different. So how exactly is the comparison being done?
Can we answer all these questions when the session is over?
Fine.
Yes, thank you so much.
Okay, so now what we can see is the portfolio performance is the blue line that is highlighted here versus the benchmark line, which is the black line over here, right? The portfolio performance will always be in blue. So that's the benchmark black, and blue is in the portfolio performance. So we can see that the cumulative portfolio performance was a 67% starting from 1st of Jan 2020 onwards versus the benchmark performance of a 48%. So if we have a look at the CAGR of the portfolio, that's a 15% CAGR versus a benchmark CAGR of 11.56%. Next, we can also have a look at the Sharpe ratio. That typically means what was the risk that this particular portfolio undertook to generate these particular returns. Okay, so Sharpe ratio tells you the risk adjusted returns of the portfolio for the time period under consideration. So we can see higher the Sharpe ratio, the better it is. That's the specific norm. So we can see that the portfolio Sharpe ratio is a 0.72 versus a benchmark Sharpe ratio of only 0.38. So definitely our portfolio is a little better with respect to generating a better risk adjusted returns. That can also be seen in the historical value at risk as a parameter, which tells you what is the value that is invested in the portfolio that is at risk. At risk of what? At risk of losing. So how will you interpret this? So for an example, with a 95% confidence interval, we can see that the downside risk of the portfolio is generating a loss of a 15.36% negative 5% of the times. How do I come up with 5%? 100 minus 95, that's 5%. Therefore, the downside risk of the portfolio of generating loss is a 15.36%. In other words, if 100 rupees is invested simultaneously in the portfolio as well as the benchmark, your capital protection will be in case of the portfolio 85 rupees, and in case of benchmark will be around 83 84 rupees. So that's definitely a good downside risk protection, definitely by a very thinner margin, but definitely a portfolio is better than the benchmark even in downside risk. That's the historical value at risk as a parameter. Next, we have the up capture and the down capture ratios. So what these tell you is what was the performance of your portfolio versus the benchmark in a bull run. For that, just click on this I button. And when you click on that, you will see that all the benchmark month-on-month numbers, only when the benchmark given positive returns are covered here. You will see that April and then directly June. Why is May not included? That's because in May 2020, the benchmark would have gone down, right? And that's the reason we've not included that in the up capture, because here we are typically saying the bull run in the benchmark. Okay, so in this case, we can see that April 2020, the benchmark went up by a 9.22 versus the portfolio went up by a 7.81. Right? And cumulatively, if we take this, cumulatively month on month, if we take this, so that amounts to 43% upside by the portfolio versus the benchmark upside by of a 40.56. And because this is higher than the benchmark up capture, that's the reason we see that this ratio is more than 100. And that's typically the goal. Higher the up capture ratio, the better is the portfolio's capture in a bull run. Conversely to this, the down capture ratio tells you the performance of the portfolio in a bear run. Okay, so in this case, the benchmark, only those particular months will be included when the benchmark given negative return. And that's why we term it as a bear run. So for an example, in this case, in May 2020 as a month, the benchmark fell by a negative 0.25%. On the other hand, your portfolio as a whole actually rose by a 0.50%. Right? So that's how resilient is your portfolio to a bear run. That can be highlighted using the down capture ratio. Next, when we have a look at the month-on-month split of the returns of the portfolio, we have the monthly statistics. Okay, so that tell you that from the start date that we have considered, Jan 2020 onwards, how many total months have elapsed. So 43 total months. Out of those 43 months, 30 months were such when your portfolio given a return in a positive quadrant. That's why they are up months. So 30 out of 43, that comes to 69%. And therefore, the percentage of up months is a 69%. Similarly, down months is 13 out of 43. And therefore, the percentage is a 30.23%. Right? That were the monthly statistics. Now moving on to the next crucial tab, wherein we'll discuss the contribution of each and every component of the portfolio to the overall portfolio return. Please note that the portfolio return here, cumulative, is a 67% return of the portfolio from 1st of Jan 2020. Now let us have a look as to in this 67%, which of the components in the portfolio have contributed to what extent. For that, head over to the contribution tab. When you go to the contribution tab, you will see that out of the total portfolio return of a 67%, PGIM contributed 14.29%. So out of the 67% portfolio return, 14% has just come in from one single fund. That's PGIM India Midcap Opportunities. On the other hand, in itself, what was the performance of the PGIM India Midcap Opportunities Fund? Irrespective of the fact whether it was a part of the portfolio or not, this fund gave in a return of 158.70% in this time period, in this 3.5-year time period. But because its portfolio allocation was only a 13%, it could contribute only 14% in the overall portfolio return. That becomes a crucial analytics point. And if this allocation in the portfolio of PGIM would have been more, your portfolio return would have definitely increased. That's a insight that you can definitely make out from this particular analysis. And you can check this for each and every component. So of course, in this case, we have only 8 odd funds in the portfolio. Therefore, this is very, very clear. But if there are more funds, let's say like 15, 20, 25, you can just do a drag on zoom. When you click on that, this will get enlarged, and you can actually check of each of the funds. So UTI Corporate Bond Fund, independent of it's independent or in itself performance, independent performance was a 23% in the 3.5-year period. But because its allocation in the portfolio was a 13.19%, its contribution to the overall portfolio return is a 2.85%. Out of the total of a 67%. The least contributor was a Kotak low duration fund, which contributed only 2.50% in the overall portfolio return of a 67%. This is the individual contribution analysis that you can do. Towards the end of the webinar, I'll also show that how you can remove one particular fund, which is the lowest contributor to this portfolio, and actually replace that with a better fund and check the contribution analysis. So we'll keep that towards the end. We'll continue with the flow of the webinar right now. So that's the contribution analysis. Next, we have the rolling returns analysis. Again, rolling returns analysis becomes very crucial with respect to checking the consistency of your portfolio performance. For that, directly head over to the rolling analysis tab. When you come to rolling analysis, we'll have a look at what was the consistency of this particular portfolio in generating returns. So let's consider a time period of 6-month holding period, 1 year, and directly a 3-year. For that, you'll have to customize these windows. Currently, these are set as 260, 520, and 780, which is equivalent to 1 year, 2 year, and a 3 year. So if 260 is 1 year, so 6 months will be 130. I'll just change this to a 130-day window. Next, I want a 1 year, so it will be 260-day window here. And the third window, of course, will be 780 days. That's a 3-year window. That I'll keep this as 780 only. And now I want to choose this methodology as annualized return, and I click on run. So now the blue line that you can see here tells you if the holding period of any particular client in this of this client is 6 months, what would be the returns that would be generated by this portfolio in the entire 3.5-year duration. That means from January 2020 till July of 2023. In this 3.5-year period, if the client would have held on to this portfolio for a 6-month period, 130-day period, what would have been the average returns? It would have been 17% annualized returns. If you want to check the exact 6-month returns, because this is a period of less than 1 year, if you want to have a look at the absolute returns, we have a toggleable button here. Because that's a less than 1 year period, just click on absolute, and you will have exactly in the 6-month holding period, the average returns would have been 8.50%. The highest that this client would have ever gone if the holding period was 6 months, that's 130 days, in entire span of 3.5 years, it would have generated a return of 28.20%. This entire portfolio, mind you, this is not a single fund analysis that we are doing, the entire portfolio analytics. And the lowest that this portfolio would have ever given in a 6-month holding period would have been a negative 9.95. So the range, as you can see, is pretty much higher. So it can go as high as 28, it can go as low as negative 10, right? But now what you can typically highlight is as the holding period increases from a 6-month to a 1 year to ultimately a 3 year, which is generally the case when clients invest in a mutual fund portfolio, that we try to convince that the longer you hold, the better would be the returns, and that's typically highlighted here, right? As the holding period increases from a 6-month to a 1 year to ultimately a 3 year, the lowest that this portfolio has ever generated turns out to be positive, right? So in this case, 6-month negative is 19.90. As we hold on it to a 1 year period, it becomes a low of negative 3.08. And as the holding period increases to 780 days, that's 3 year, the lowest that this portfolio has ever generated also becomes positive, and that's a 13.32% positive lowest return, right? The average return, of course, is a 17.03%. Next, we have rolling returns distributions. Now, this becomes crucial to actually understand how much is the client's target return range, and does this particular portfolio of the client meet the client's target return range? And if it does, how much percent of the times? Very, very crucial analysis. How can this be done? So let's consider that this particular client is going to, hold on. You want to show this analysis for a 1 year holding period. From this drop down, select 260 days. Okay, that's a 1 year holding period. Now, if we if this particular client comes to you and says, look, my target return range is from this portfolio or any other case is to generate returns between let's say 10% to a hypothetical high of 50%, and then he wants to know that this portfolio, how much percent of the times does it meet the target return range? All you need to do is head over to rolling analysis, head over to rolling returns distribution, and in any of these 5 tabs, just put in the target return range of the client. For an example, I'm putting it here. So the target return range of our client, Raj Malhotra, was to generate return between 10% to 50%. Put in these 2 parameters here and click outside. And you will actually see that this portfolio of the client meets the client's target return range 61% of the times, right? So it gives return between 10 to 50%, which is the client's target return range 61% of the times. That's definitely a good probability for a portfolio to generate target return range, right? And you can definitely create a series. So let's say you want to check in the negative quadrant, how much is the portfolio, return, how much, percentage of the times it generates negative returns. So let's consider a hypothetical low of, let's say, a negative 25 to a 0%. You can just go on creating a series and you can actually check what is the probability that this particular portfolio we will backtest in this negative quadrant. And that comes to a probability of a 7.50%, close to 7.59%, right? So 7.5% of the times your portfolio will generate returns in negative, like this. Right, you can definitely create any particular target return range and check the series and actually give this insight to the client. That's the rolling returns analysis that's available right here. Moving on to the next crucial part, which is the scenario analysis for a particular portfolio. So for that, directly head over to the second last tab, which is the scenario analysis. When you go to scenario analysis, you can actually choose from any scenarios that you have already saved, or you can build in your own custom scenarios and check the performance of your client's portfolio in that particular scenario. So let's say, for an example, nothing great. I'm just taking a simple year-to-date scenario of 2023. First 6 months. We are already into July, and first 6 months have passed. So let's take in a scenario of 2023 first half. So what I've really done is I've saved in this particular scenario. I've named it as to 2023 year to date. And of course, the start date is 2nd of Jan 2023. And the end date is 30th of June 2023. Okay. In this particular 6-month period, the portfolio performance was 7.58% versus the benchmark. Of course, here in this case, it's a reference index 5. If you just click on it again, it will definitely change into a custom benchmark that you would have created. And we can check that the performance of the benchmark was a 4.43%, right? So it's definitely an excess return of the portfolio to an extent of 3.15%, because 7.58 plays a 4.43 with the volatility which is lesser than the benchmark volatility. Benchmark's volatility or the standard deviation was a 5.56%. On the other hand, the portfolio volatility was a 4.75% only in this particular scenario. You can now create your own custom scenario as well. So just head over to add custom scenario, put in the name of the scenario, put in a start date and an end date, and click on save. And your custom scenario will be saved. You can just click on it and have the return performance of your portfolio against that particular scenario. Right. So in this case, I've taken a Adani fiasco as a scenario. So happened during the first couple of months of this year. So 2-week period is what I've taken. And the black line is the benchmark line and the blue line is the portfolio performance. So the benchmark went down by a negative 1.77. On the other hand, the portfolio went down, but only by a negative 0.07. So this is analysis that you can definitely highlight. That was the scenario analysis. Now we have a drawdowns analysis, which becomes very, very crucial with respect to understanding the strength of the portfolio to recover from a loss. Because how much ever curated portfolio you make, so how much ever research analytics you do, how much ever very, very understanding the client's risk profiling you build a portfolio, it will never be immune to losses. When markets are volatile, it will definitely have an effect on your client's portfolio as well. But then in such times, what really becomes crucial is to highlight how quickly does it recover from that loss. How resilient is your portfolio when markets are in volatile times, right? So that is typically highlighted by the drawdowns analysis. That's the third last tab in the portfolio analytics. When you come here, you can see that we have listed down the worst 10 drawdowns of this portfolio. And let me just interpret this first one for you. So in this case, it says that there was a loss of a magnitude of 23.73% between 20th of Feb 2020 to 23rd of March 2020. That typically means within a 1 month time period, the portfolio fell by 23%. When the weighted average NAV of the portfolio fell from 104.54 to a 79.73. Of course, this is the weighted average NAV of the portfolio. You will not be able to corroborate this anywhere. That's because it depends upon the weights of the portfolio and, of course, their ultimate NAVs of the components of the portfolio. So 104, from 104, it fell to 79. And after that, the portfolio took 107 working days to recover this entire loss of 23%. This is exactly highlighted here in the gray portions. So if you were to just hover on the gray portion here, which is the steepest downfall, you it need not be the size of the, the length of this gray box, but the steep drawdown. So this is, you can see, this is the worst drawdown. Steepest downfall, that's a 23% downfall here. This is highlighted here, right? So there was a downfall of 23%. Started, of course, was 20th of Feb, which will be right here. And after that, if we were if we try to hover on 19th of August 2020, somewhere in this white area, we will actually see that the NAV of the portfolio would have crossed 104.54. Let us just check that. So 19th of August 2020, let's try to hover somewhere there. Okay, so we are on 20th of August 2020, and the NAV has already crossed 104.54. The NAV is 105.06, and therefore we anoint 19th of August 2020 as a recovery date. Okay, so that's the drawdown analysis that you can do on a portfolio level. Now, if you want to do a singular fund level drawdown analysis, okay, which are the components in the portfolio, and you want to do a drawdown analysis on that. So we have introduced that as well. So for that, all you need to do is go at the top. When you scroll at the top, you will see a compare option here. Just click on that, and all the components in the portfolio in a single click will be added to the compare section. Okay, you need not add them one by one. In this case, there were 8 components in the portfolio. All of them have gotten added in the compare section. Now, let us do a drawdown analysis on each of these funds. Okay, for that, head over to drawdowns tab, which is our third tab. When you go here, just you need to ensure that the start date is the same. So 2020 of January is what we were analyzing the portfolio for. So 1st of Jan 2020. And now we can see that the sizes of these particular funds and their drawdowns are listed here. So in this case, Kotak Low Duration, UTI Corporate Bond, which are typically debt funds, have actually had the minimum drawdown, right? So in the overall portfolio drawdown of whatever we were just analyzing, this one, right, this 23.73, the contribution of debt funds to towards this drawdown, what was that, and what was the contribution of the equity funds to that? That is exactly what is available here. So in this case, Bandhan Sterling Value fell the highest. 43% loss happened in this particular Bandhan Sterling Value fund, right? And what was the exact details of that? Just click on this particular chart, and you will see that the NAV of the fund fell from 50 rupees to a 28 rupees. That's exactly a loss of 43%. Okay, and this happened within a 3-month time period, 24th Jan to a 24th March, 2-month time period. And after that, the fund took 175 days to recover. Right, this is the in detail fund specific drawdown analysis. This tells you what is the strength of the fund to recover from a loss. And then ultimately, when these form a component of the portfolio, this will tell you what is the strength of the portfolio to recover from a loss. Right? You can, of course, rank this on the basis of their recoveries, rank them on the basis of their second worst drawdowns. All of that is definitely available. So, but today, as we are doing, portfolio analytics, I just wanted to give you a sneak peek of how you can do a singular fund drawdown analysis as well. But let us go back to portfolios again now. So this is the portfolio level drawdown analysis that you can do. Okay, and now let us have a look at some reporting options on these portfolios analytics. So for reporting options, we have 4 reporting options. First one is a static PDF. So there's a 4-pager detailed consolidated PDF that gets downloaded. Just click on this and you can have an option to actually now have a watermark of your organization logo. Just click on this checkbox and click on create PDF. When you click on that, a PDF will get downloaded and this is how it will look. Right, this is a 4-pager detailed consolidated presentation of your client's portfolio. You can see the watermark appearing right here. So it is being benchmarked against custom benchmark 2, which is the benchmark that we just built. Its performance against that particular benchmark. We were running this analysis from 1st of Jan. All of that is typically highlighted here. And as you scroll down, you have the asset allocation of the particular client's portfolio, the components in percentage terms, what are its underlying top exposures, the entire analytics that we just did that gets exported into a PDF. And of course, we have highlighted the rolling analysis, very, very crucial, and of course, the drawdowns, right, in the PDF. Now we have also given a PowerPoint option. Let's say you want to highlight this particular scenario that we just did, right, to the portfolio, to the clients. Then you need to just head over to the PowerPoint option and you can actually generate an amount-based proposal for the client. Okay, so let's say this particular client has a AUM of, let's say, at 1 CR, right? So just put in 1 CR here and just click on create PDF, create PPT, sorry. When you do that, a customized PPT will get downloaded. I'll just open that for you. Okay, so this is how the PPT will look like. Because this was an amount-based PPT, you can see that the capital of 1 CR is gotten captured here. And what it will really do is everything, all of these exposures will now be in amount terms, right? So 13 lakh to PGIM India, 10 lakh, 10.56 lakh to a Motilal Oswal, so on and so forth, right? And here is where, because it's a PPT, what you can do is head over to the last or the second last slide and actually click on insert a slide here and highlight the scenario analysis that we just did. Click on insert a new slide. Of course, the layout will be similar to what is there for the previous slides as well. And here is where you can actually introduce the scenario that you were trying to highlight. Okay, let's say a year-to-date scenario is something that you want to highlight. Just take a snip of this by clicking on screenshot, or alternatively, just by clicking on detailed snapshot button. Just introduce this particular snapshot there. 1 second. Okay, there's a snip. Let's say you want to highlight this particular scenario, take a snip of it and go back to the portfolios. PPT, just paste it here and your job is done. So this is how you can highlight this particular section specific scenario for your client in the PPT, and then just save this and send it across to the client. So this is how you can highlight as many scenarios as you want. We have not included it. Default is because for different clients you would like to highlight different scenarios, and that's the only reason that we have not included a scenario analysis as a default export option in the PowerPoint. You can definitely add it. These are the 2 reporting options. Next, we have the client link and the share link as well. So a share link, what this will do is it will copy the entire link of the portfolio. Just click on copy, and this entire detailed analytics will get copied as a link. All you need to do is share this with the client on maybe an email or a WhatsApp, and then this is how when he clicks on that particular link, this is how it will look. Okay, this is a dynamic link. When the client actually changes the start date and checks the performance, he can definitely check that. He can take PDF exports from this. He can check the contribution. He can change the start date and end date and check how the contribution of the components in the portfolio changed over a time period. So all of those customizations will be there. So there's a live link that is there. Okay. And next is the mobile-based preview. So if you want to have a, have to share this portfolio analytics with the client in the mobile-based preview, just click on client link. And when he clicks on, put in the client's mobile number, and a SMS will be sent to the client. When he clicks on that particular link, this is how the portfolio analytics will look like. Okay. So performance of the portfolio with the benchmark, analytics, markets, what are the levels, all of that will be visible like this. These are the 4 reporting options. So now that typically brings us towards an end of this topic specific webinar. Just before closing, I will just show how you can edit the positions that we were just discussing in the contribution. So when we were discussing contribution analysis, we had figured out that Kotak low duration fund contributes the lowest to the overall portfolio return. And if you want to now remove this position and show this to the client, how will you do that? Okay, so just click on edit or save as and remove that particular position. So Kotak long duration fund, so 13.19, just remove this particular position. And let's say you would like to the client to go ahead with a whitelisted fund from your search, and that's let's say a SBI blue chip or a HDFC top 100. Just replace that with that particular fund, and you will the exact allocation to be added. So 13.19. So let me just add in a SBI blue chip for that matter. Give it an allocation of a 13.19 so that we ensure it's an exact replacement that's being done. And now you have an option to either update the holdings or save as new. Okay, so you can save it as new also. So, and you can actually show, let's say, Raj Malhotra save one, right, or a revised, and click on create. Once that is created, click on run, and you can again do the same portfolio analytics, and you can actually highlight what is the contribution of the particular funds in the portfolio return. So in this case, you can see that SBI is now contributing the among the top 3, right? 11.21. Of course, we have replaced debt with equity. I mean, it's not an exact asset class replacement, but this is how you do it. This is how the functionality works. So that typically brings us towards the end of this webinar. If you have any queries, please ask them. You can do so by either unmuting yourself or typing in your queries in the chat box. Thank you. So we have a question in the chat box that says, can you show the drop down again? I think drop down of what? Okay, so in asset allocation, if that is what you were referring to, in the asset allocation, we have concentration, and you can check this concentration as either as a percentage of total portfolio or as a percentage of equity exposure only. So in this case, you can see that this entire portfolio, of course, this is the revised portfolio. So it has equity of 67% and debt of 25%. Okay, you want to just see out of this entire 67% equity exposure, how much is into large cap, mid cap, small cap. Then click on concentration, click on this drop down, and click on equity exposure only. Then you will see that large cap amounts to 60%, considering 100% as equity now. Okay, 30% is in mid cap and small cap is 9%. You want to check this as an overall portfolio exposure, total portfolio exposure. Click on total as a percentage of total portfolio exposure, drop down. And now whatever others you can see is now anything and everything that is not equity is getting classified as others. It could be debt, it could be cash, it could be foreign equity, and so on and so forth, right? So that's typically this drop down.
Hi Prajakta, I just had one question. The place where you were allocating to index, like
Yes.
allocated custom index in
Yes,
that
yes.
55% to Nifty 50.
Yes.
So I just wanted to know, when we go and back test it, so does the allocation accordingly change? Or I mean the like maybe large cap would have been at that time 65% and index is only 50. So does it change according to that? I mean,
Yeah, got it. So, so typically when you change this benchmark, we are doing this analysis as to these were the weightages. Of course, this is as of today, right? This allocation is whatever date we are running this analysis on. right? So it will take into consideration, these weightages only. These will not automatically change. That will be the weightage that we put, and it will benchmark it against that particular portfolio. The changes that are not getting captured. So the
Yeah,
dynamic.
hi, this is Arnab. So here, when you create your custom index,
Yeah.
this will actually create a historical price series, which is made up of these three indices in these weightages,
Okay.
right?
Okay.
Obviously, going back in time, these weightages is not going to change. They're going to remain 55, 40, and 5,
Okay.
right?
So
And
what-
ideally, you don't want your benchmark to continue to change, right? Otherwise, there's no point in benchmarking. If your benchmark is continuously changing, then it doesn't kind of serve a purpose, right?
No, sorry.
Because yeah.
Allocation. I'm not talking about like changing Nifty 50. I'm talking about
Okay.
the allocation in Nifty 50. Like going backwards.
Yeah.
So the portfolio allocation also changes. So
Yes.
benchmark allocation should also change, right? So 55% right now we are putting in, but maybe that was 43% that time. Like how, going back, how does it exactly compare? I'm just
Right. No, so that benchmark is independent of your portfolio, right? Because if you want your benchmark to continuously adjust
yes.
to your portfolio's asset allocation, then it's not really a benchmark, right? Because you know
Okay.
what I'm saying. Because if you decide to, let's say, reduce your small cap allocation this month, right? Does that mean that the benchmark will also reduce it? Because I mean, it's supposed to be as a guide, right? Generally speaking, are you doing better than half equity, half debt? Then it will then your performance will show the value of your asset allocation decision, right? But if the benchmark's asset allocation is exactly the same as your portfolio, then the only difference it will show is in stock picking. But in any case, the issue here is that your portfolio's historical weightages are not there anyway, right? Whatever portfolio weights you put here are the latest ones.
Yes.
So you can create a benchmark according to whatever your asset allocation is right now and use that.
Okay. Okay.
So there's a
Yeah.
question. Yeah.
Go ahead,
There's
go
a
ahead.
question in the chat box which says, in compare funds, can we check amount wise historic return? Example, if 1 lakh is invested 5 years ago or 10 years ago and its current value. Yes, of course, we can do that. So for that, head over to the compare section, and these are all the funds that we have in the compare section. And let's say if I think your question was how much? 1 lakh. Yeah. So if 1 lakh is invested, head over to point analysis and put in the lump sum value as 1 lakh rupees. Okay. Once you put in 1 lakh rupees here, just specify the time periods. We have given you 5 different slots. So first slot could be a 5-year period. So 5-year period is 2018, 27th of July to 27th of July, 2023. This is a typical 5-year period. What would 1 lakh become in 5 years? Second scenario could be a 10-year ago scenario. So 27th of July, 26 because it was a non-working day. So 2013 to 27th of July, 2023. That's typically a 10-year scenario, right? What would have 1 lakh? What would 1 lakh become in 10 years? Okay, so 1 lakh would have become 5.70 in case of Parak Flexi Cap and so on and so forth. Just build in your scenarios of your choice, and you can actually check in value terms also how much they would have performed. This can also be checked in percentage. I mean, it's just a toggleable button that can be really used. Next, how can we decide which benchmark is to be considered? Okay, so when you choose in a portfolio, it will automatically benchmark the portfolio's performance against the reference indices that we have created. So for an example, let me just quickly go to the client section And this is 100% equity portfolio that is there. Okay, Anurag Khatri as a client has 100% equity based portfolio. When I click on run analytics, default it will consider for this particular portfolio a reference index 1. What is this reference index 1? This is created and curated specifically by Team Engine, considering various combinations of Nifty TRI and a CISL bond index. Okay, reference index 1 is 100% Nifty TRI. Okay, because it's an equity oriented portfolio only, as you can see here, it has benchmarked it directly against a reference index 1 automatically, which is 100% Nifty 50 TRI. You can change it, of course, but auto benchmarking will happen.
Any other questions? Please just unmute and ask.
Hello.
Go ahead, please.
हाँ ये जो ड्रॉडाउन्स है
हाँ जी.
तो ड्रॉडाउन्स में आप पोर्टफोलियो को जो बता रहे हैं कि भाई इतना दिन लगा रिकवर होने में, तो उसके साथ बेंचमार्क का कंपेयर कर सकते हैं कि मानो कि बेंचमार्क को ये टाइम में बेंचमार्क कितने टाइम में रिकवर हो गया और ये इतने टाइम में, तो उसकी एक प्रोबेबिलिटी निकल के आएगी कि भाई पोर्टफोलियो अपना 70 टाइम बेंचमार्क से पहले ही रिकवर हो जाता है या 60%, 70%, 80%.
हाँ जी. तो पोर्टफोलियो का जब हम ड्रॉडाउन दिखाते हैं तो बेंचमार्क का उसके साथ में हम नहीं दिखाते. ये एक्चुअली हमें कुछ लोगों ने सजेस्ट किया था, इसमें हमने इसलिए अभी नहीं डाला बिकॉज इस चार्ट में आप देख सकते हैं काफी सारी चीजें हैं. अब अगर हम सेकंड सीरीज डालेंगे तो उसका भी बैकग्राउंड, जैसे इसका ग्रे में हमने ड्रॉडाउन को मार्क किया है, तो फिर उसके भी 10 ड्रॉडाउन मार्क करने पर तो भीड़ सी हो जाएगी चार्ट में. तो इसके लिए हमने क्या किया, अगर आप फंड के ड्रॉडाउन वर्सेस बेंचमार्क के ड्रॉडाउन देखने में इंटरेस्टेड है तो कंपेयर सेक्शन में अगर आप क्या करेंगे कि आप 3-4 फंड डाल दीजिए जैसे यहाँ पे डाले हुए हैं, और साथ में 1-2 बेंचमार्क भी डाल सकते हैं. तो जैसे हमने निफ्टी 500 डाल दिया और एक और कुछ डाल दो प्रोजेक्ट का सेंसेक्स डाल दिया. तो अब हमने इंडेक्स भी डाल दिए, कुछ फंड भी डाल दिए. अब हम ड्रॉडाउन्स के सेक्शन में जा सकते हैं, यहाँ पे साइड बाय साइड कंपैरिजन हो जाएगा किसी भी स्टार्ट डेट से लेके अभी तक कि वर्स्ट ड्रॉडाउन निफ्टी 500 के कितने थे, बंधन स्टेलिंग वैल्यू फंड के कितने थे, रिकवरी टाइम कितना है. तो यहाँ पे एक ही शॉट में आपको दिख जाएगा. अगर आपको डिटेल देखना है किसी का भी कि आप सोच रहे हैं ये 43 बहुत ज्यादा है क्या था, तो आप क्लिक करेंगे तो आपको इसका डिटेल भी दिख जाएगा.
राइट. ओके ओके,
थैंक यू. There is a question in the chat asking for every portfolio auto benchmarking will happen. Yes, pretty much. I think if you run any portfolio in the portfolio section or even in the client section, by default, I'm pretty sure what will happen is it will choose one of the NGEN benchmarks, right? So it will not choose 30% Nifty 50 debt, etc. It will put your portfolio into one of these 11 buckets. And the 11 buckets are from one extreme, which is 100% equities, all the way to the other extreme, which is 100% debt. And it shifts in 10% increments. So the way it decides that is through the asset allocation. So Projector, let's just go to the asset allocation. Yeah, so you can see equity is about 60%, the rest is debt, mutual fund, etc. So the one that it has chosen in this case is reference index 3, which is a 20% debt. So our trigger is actually our debt allocation. So in this case, your debt allocation was about 16%. And so it's used that and put you in the 20% debt remaining equities bucket automatically. But of course, you can just click here and change it to reference index 4 or 5, whatever you think is more relevant. Now, if as the person who asked earlier, you want to actually make your benchmark very customized, you can then create your own custom benchmarks. as per your own desire and change it. But we automatically benchmark you to these 11 pre-created indices that are available from India. Great. Any other questions, please ask. Okay, Prajakta, if there's nothing else, we can close for today.
Yes, so thank you everyone for joining in. You can find the recordings of these webinars on our YouTube channel. So for that, directly head over to our YouTube channel, and you will have a list of all the recorded webinar recordings in the playlists that are updated here. So you'll have even this webinar recording uploaded in the due course of the week. So by Wednesday or Thursday next week, you will see this webinar recording available as well. So thank you everyone for joining in, and have a great weekend ahead. Thank you.